Welcome back to the channel. I'm Foreman, and in this video I'm going to be talking about the UK stocks that I'm buying right now, as well as giving an up-to-date market commentary on Boohoo, their potential takeover, Asos, and also JDSports fashion, as well as Associated British Foods, the parent company of Primark. I aim to give a little bit more insight into the fashion industry today, but the main topic I will be talking about is, of course, Boohoo's potential takeover. But before we get into that, my portfolio itself has done mediocre again this week. Unfortunately, my data on Google Finance hasn't refreshed. That's quite annoying, if I'm honest with you. I don't think there's really much I can do about that because it does just glitch out. But this week, my portfolio is down 1.78%, or about £300. Overall, in 683 days, I'm down £12,513. If you've not seen my latest video where I was responding to the hate comments or the negative comments from a video before, then click that card at the top right, because I talk in depth quite a bit about this and my strategy. But effectively, now that I'm down an amount such as this, I have mentally written it off. The idea here is that I've mentally written it off so that I know that if there is a change in the fundamentals of any of my companies, that I can sell without any emotional attachment. This means that, let's say Boohoo announces that actually business isn't going swimmingly, they're really struggling, and that actually their business model is very, very weak. At the moment, obviously, they've seen total sales grow in the UK by 32%. But if this is a change of pace, there are some other factors that perhaps I'd overlooked. At that point, yeah, the share price would be down on the day. I would therefore just sell the position and cut it out, because I'm invested until there's a change in the story. At the moment, the story hasn't changed. The fundamentals have deteriorated. And I do imagine in the next few years it will continue to do so as inflation is rife and disruption in the supply chain is also amongst us. However, I believe that over the longer term, that if they're able to grow by at least 15% each year in terms of total sales, which is quite conservative even compared to their medium-term guidance of 20 to 25%, I think that eventually the share price will reflect the underlying fundamentals, and I will see a substantial return on investment over time, because at the moment Boohoo is priced to a point where they're looking at their earnings as if going forward they're going to have very minimal earnings for the future of the company, which I do not believe in. But in that regard, I have obviously written that off mentally. I've not cashed out. And there's a lot of people that say, well, it's not a loss until you sell. Again, you can use that mentality, but then it becomes very difficult to sell. I'm not falling for that bias. Instead, I know that if I have to, at any moment, if both of my companies have fundamental changes in the stories, boom, I will cut out and cut my losses and therefore research and look elsewhere. But I have no need to do that at the moment. But as we can see, we're nearing 700 days of the portfolio, and I'm nearing 43% of a decline in my total investments. I expect that this may be a pivoting point, where at the moment you may be looking at me and judging me, perhaps because I'm down by such an extreme amount, but I hope to come back 2, 3, maybe 5, 10 years time and look back upon these videos where I was really struggling and my portfolio performance was very much lackluster compared to the indices, and I would like to see how times have changed. I looked recently at my first ever portfolio update video, and the difference, a stark contrast in investment strategy, even confidence on camera, is phenomenal. So I would suggest go check out like an older video from like 2 years ago. It is quite a substantial difference indeed. And I want to see this, and I hope that you guys can also learn through my journey. That is, after all, the purpose of the channel. I am as open and as transparent as possible in hopes that you're able to digest the information that I provide and then therefore use that information to benefit yourself when investing in the stock market, or even just to do with personal finance. If I make mistakes publicly on the portfolio, I've not got an ego and I'm not here to hide them. Instead, I'm going to try and learn from them, and I hope that if I make some costly mistakes, that you guys are able to learn from my mistakes by learning from others, and therefore avoid those mistakes yourself and potentially do better than me in investments in the long run. And that is effectively the purpose of my channel. So my portfolio, as I say, is down for now. I've got a cash position of 1.5%. I deposit £1,000 a month. That will be deposited on the 25th, and I'm therefore splitting it into each week, where I'm investing about £250 each week. This week, yes, I've bought less shares of Boohoo. That is a given, and the purpose behind this is because I'd spent £375 in the previous week. Shares have recovered a fair amount this week. I mean, they're sitting about 91 pence, but this is due to the fact that there were rumours over the takeover of Boohoo, which is certainly the topic I really want to dive into next. Now, I must clarify that the chat rooms on the London Southeast page, I do not frequent them. I have looked from time to time, but they are very good at evaluating whether there is a rumour or not, or find the information that you personally can't find. So on this website I can see here, and obviously I am signed in, that is my user ID. I don't post. I think I've got 3 different posts back when I thought there was value to this, but they were saying that Boohoo is being looked at by a potential buyer according to a Betaville report. I initially saw this on Twitter by this exact post, and I will get onto that in a bit, but it does seem very interesting, and I think sentiment perhaps is one to be watching in the chat rooms. So on Twitter I was like, does anyone actually have a source for this? And then I had my own little egocentric comment after it saying, funny how days ago people were telling me to sell, and now those same people are rushing back into the stock over, obviously, rumours of a takeover, looking at by a potential buyer. But actually this narrative was very much adapted. This was very much a rumour so far, and because when I dive into it, and again my best source is again the Boohoo share chat, but apparently in case anyone has not read it, here it is. It says Boohoo shares jump after Betaville uncooked report, and this was on Wednesday, February 16th at 10 minutes past 4. Boohoo shares erased earlier declines and jumped 9% following the report, mentioning a potential takeover interest in the online retailer. A spokesperson for Boohoo declined to comment on the story when contacted by Bloomberg. Betaville says that people following the situation that have heard speculation that Boohoo is being looked at by a potential buyer. Note the speculation is described as uncooked, a term used by the Betaville blog often, which refers to market gossip, effectively saying that this is a rumour. Shares on that day had bounced quite a high amount, and effectively there is no comment on that. But it does amuse me because even though there's no comment, right? And they're bouncing on this rumour, people are like, yes, get in, this is going to the moon, this is where it's exactly going. 250 to 300 pence is possible here. Why be that optimistic? Why does it matter? In fact, I think Boohoo being taken over is more of a negative for long-term holders. Now, I don't know who this person is, and there's no hate towards this person because that's not how we personally develop in the investing game. And I think everyone is entitled to their own opinions. It's very likely that this person here is a trader, perhaps a short-term trader or more of a swing trader. So for them, buying at roughly 90 to 100 pence a share and then it's swinging up to 250 to 300 pence is a fantastic trade. Whereas someone myself, my average price is obviously £1.74 or 75 pence per share, and so I'm significantly underwater at the moment. I'm down overall by about 40 odd % in my position with Boohoo. I think it's closer to about 45%. But a potential takeover isn't a good sign. If you're a long-term investor and you truly believe in the company, to find that it's going to be bought by a different company, one that may not even be a public company in the first place, is very much not a good thing. Especially when you consider the fact that Boohoo shares are down significantly. They're down 72% in the last year. And effectively, I don't know truly the rules behind takeovers, but there is some speculation here that they have to buy it within the 52-week highs. I'm not so sure about that. But effectively here, this would be a large concern because the premium therefore offered on the shares of Boohoo, whilst they are at a very low valuation, would therefore not be good for the long-term holders of the company. A lot of these people are invested for years, and so a takeover of Boohoo may mean short-term profits, but then you've got to then again find another place where your capital can go into another good company in your opinion, which I think are very much rare to find, especially when you put all the research into it. But then it's also important to mention, and I need to change the ordering up here, but on Simply Wall Street we can see the ownership breakdown. You can see here that the ownership breakdown is about 23.3% of individual insiders, 16% being by Mahmood Kamani, who is the founder of the company, alongside Carol Kane, another founder or co-founder of the company, and Mahmood's brother, and I can't say his name, but Rabia or something like this, owns 4.49%, overall equaling 23.3%. If a company had a potential interest in buying Boohoo, and they would have to buy the shares of the public offering, and they would have to buy out effectively everyone, they have very much a controlling stake that can allow them to deny it. They could flat out refuse it. Don't get me wrong, 23.3% isn't the most strong stake you could have to prevent this, but it is a very, very well positioned one. And this is very much a family run business. After all, Mahmood, the founder's sons, I think it's Umar and there's another one I've forgotten, they both co-founded Pretty Little Thing together, which was then acquired by Boohoo, and I guess, yes, there is some negativity around that, but is a fantastic business, do not get me wrong. And so this is a family-run business, and this is the same sort of thing where we talk about Asos as well, and I will come back to Asos in a second, but Asos, effectively, they're moving from the AIM market to the main market, and I will talk about that shortly. But when Boohoo is listed on the AIM market, they do it because there's no inheritance tax. This means that when eventually one of them moves on on. Well, I say moves on as in they go to a different world sort of thing. That was a very PG way of putting it, I suppose, or they've gone to the farm. Effectively, then they can give the shares to their either siblings, next of kin, etc., and they will not have to worry about any forms of inheritance tax, or I believe it is very much minimal. And this is the primary advantage for Boohoo. Now, you may say, okay, look, there's a potential takeover of Boohoo incoming. In order to do this, this doesn't mean Boohoo is completely defenseless. Yes, this would likely be a hostile takeover, where the person looking to buy the company or the institution looking to buy Boohoo, in this position, it would be a hostile takeover because they'd be doing it against perhaps the better wishes of the management or the board of directors. Again, the board of directors already have a weapon in their arsenal, being 23.3%. What they can do, and I don't know how much wealth Kamani has, but I'm aware that apparently he is a billionaire, so he likely does have the wealth to do this. But effectively, they would be able to, and I can't remember the exact term for this, it might be poison pill, but what they can do is they can offer more shares to the market, but only offer a significant discount to those who already hold shares in the company. So effectively, when they buy back in, they'll get a great value on this, but any firm looking to really build a position in there is going to struggle. So they could say, okay, people on the register of holding shares 6 months ago, let's say this firm that was looking to take them over had only started buying in 3 months ago. This means, therefore, they would miss out on that, and it would make it substantially more costly for this firm to take over the company via a hostile takeover. There are other strategies in place. Some are outlawed, for instance, due to the fact of how manipulative it can be in a way, but they certainly are not defenseless. And Boohoo would certainly need a premium to be buying this company. And as I say, with a stake like that that's quite controlled, I think it is very much unlikely. Which brings me on to Asos, and I think Asos here, they had an article or their publication, the publication of their prospectus, and this is because they were moving from the AIM market to the main market. They, I believe, aim to therefore have a better representation. They want to be on the main market because it has a better reputation overall, and I think they'd eventually like to be in the FTSE 250, moving on to the FTSE 100 with time, which therefore gives them a bit more status, and it makes them look a little bit better as well. And there has also been speculation on Boohoo. What if there's a merger between Boohoo and Asos? Again, why would that happen? There's no real incentive. Don't get me wrong, they're two companies operating in a very similar industry, but they are two fundamentally different businesses. Yes, they could combine. Why would they? It's a very pointless thing, and again, the stake of the family would very much not be interested in this deal because Asos is effectively valued at a higher valuation than the likes of Boohoo. So Boohoo would be getting an unfavourable stake in the larger conglomerate company, and again, not something of interest. And I think this is very much a warning, or perhaps something that I really want to push towards you guys, and it's that really don't fall for short-term hype. If someone's told you, oh, there's potential takeover, question the source. Don't immediately dive in and go into the hype going, yes, Boohoo's going to be taking over. What can I do? Yes, get it. No. Calm. Emotions need to be restricted, in my opinion. I'm very good at this in a way because I'm probably a little bit gone in the head, to be honest, but effectively I can remove most emotions from this game of investing. Don't get me wrong, that doesn't mean I'm immune. I fell for the fear of missing out of Argo blockchain in the past. I completely accept that, but going forward, I'm aware that that is something I've done, and therefore I could look for the behavioural patterns that I exude before doing this, and therefore prevent myself from falling into the same traps. I've spoken about my mistake with Argo blockchain a lot on the channel, but I'll leave a card at the top right of the video for my greatest mistake, and that is where I really go into detail about that and what I've really learned from this position. But as I'm saying, it's a warning. Don't fall for the short-term hype. Things are going to do well for Boohoo, providing the changes in the company are not critical to the story, and as long as the fundamentals grow over time, I believe they'll be a good company or a good investment for the longer term. We've also got one more thing on Boohoo, and this is the fact that they were forced to drop suggestive images by the watchdog. Now, this is a bit cheeky, really, but to be fair, any business could do it. It's not like exactly the founder said, yeah, this exact model, this exact image, you do this right now and we'll get a little bit more sales on this product. This is very much likely down the chain. And the trouble is with a company, as size and scale happen, their own company or their own employees become less efficient. In this way, there's not a question of efficiency, but perhaps this can be a question of morals. Let's say the management structure where you've got fantastic, let's say, board of directors. This goes then to fantastic general managers that are managing the different brands. But then as you go down the chain, it conforms more to an average. And at that point, perhaps, whereas this specific site sale itself, it could mean that obviously more corrupt ideas come to mind, but then it's not necessarily just corrupt ideas. Anything can really happen. And I was questioned about this on Twitter, for instance, about what I thought about this, and ultimately it's not really that big of a deal for me, and it's a very, very small image, and to be honest, I don't think I'd be able to show this properly on YouTube anyway. But if you can squint at the screen here, and if you're on a phone, I'm sorry, you're probably not going to see this, but you can see that there's this lass, and she's facing the other way to the camera with this shirt saying limited edition on the back. But as you can see on the left, she's wearing like a swimsuit. So effectively, she's not just marketing the shirt, but she's also marketing her physical assets, to say the least. And so obviously, and as it goes, that kind of imagery does sell. So I imagine that would have suggested or given a boost in sales. And so obviously there is something there. But at the same time, like, a lot of companies have been guilty of doing things like this in the past. It's not like a new thing. It's not like it's out of nowhere. I think really this is clutching at straws. And I think, yes, I could have a narrative fallacy framing bias, and I might be trying to change this and deflect it onto other things in the past. But ultimately, I don't think this is a big deal at all. Don't get me wrong, I'd rather not see it. I think it's not a wise move overall for the company and their brand, but their brand is big enough and it's well diversified between different names now that obviously it's going to become a lot more difficult. I think there is one good thing to be noting of this, and it's that whilst yes, Boohoo had done this, what if other brands are doing this? But the main thing Boohoo itself is being mentioned is because their name is clearly getting clicks. And this is why we had the media article fiasco in the past. Don't get me wrong, yes, they had these articles suggesting that they were underpaying their workers, or it was slave labour. But ultimately, the realistic point behind this was it was a supplier's subcontracted supplier of Boohoo. So it was so far detached, yes, they could moderate it, but it was using Boohoo's name for their articles to get clicks. And then the cheek to ask for a donation at the bottom. But again, that's just me and my opinion of the media articles. We've also got a block listing update, which is effectively their update, which they have to do based on the laws of the exchange. And this is for their SAYE, which is Save As You Earn scheme. And this is directed towards their employees, for instance. And they've also got their Boohoo Group long-term incentive plan, which I guess is like free shares where they give it out. What they have mentioned is that the balance under the scheme of securities not yet issued at the start of the period is 13,500,000. I've rounded that down, obviously. And that is effectively how many shares that over time, once these become legitimate, I believe they have a certain period of time before they mature and are allowed to become additional securities. This is a good sign. This is a good amount of shares, and effectively, if you have more employees with a stake of the company, their opinions are likely going to align with the management, again preventing potential takeovers if more employees hold shares of the company, because ultimately they may not want to be taken over. They're going to agree likely with the management or the board of directors, or they're going to be persuaded quite heavily by this, and so therefore obviously it's going to become a lot more contested if there were to be a hostile takeover. We've also got Associated British Foods, or the parent company of Primark, and they've also released a prospectus, and this is to do with their bond issuing, I do believe, and they issued £400 million of, was it notes or something like that, and it's at an interest rate of 2.5%, and it's quite long term. I believe it's 12 years. I just thought this was quite interesting to mention because it shows that they're able to get debt at a 2.5% interest rate, which I think is reasonable and quite respectable in a rising interest rate environment. A level of debt of that amount that is long term over 12 years, they'll easily be able to pay this back off with their free cash flow. And so I think it probably was quite a wise move to do. But again, I don't believe in unnecessarily taking up debt, so it really depends on what they plan to do with this extra capital or liquidity, and if they're perhaps planning to weather the storm. But again, this is a very, very safe company in a way. Not safe in terms of volatility of share price, but rather defensive. This company during a recession is likely going to do well. They have goods that are very much inferior. Their clothing in Primark is inferior goods. Yes, you're not going to be getting as much quality, but as income decreases, the demand for their products is going to increase. And they've also got consumer staples such as food items and sugar. So obviously this company is going to do very well because, again, as income falls, when it's food items, they're still going to want that same amount of food. So food could even rise in price and they would still have to buy the same amount of that food originally in order to get where they are, because at the end of the day, food is one of the most important things. Yeah, you could probably avoid paying a month's worth of rent on your house, but you're not going to starve, are you? Because it's a matter of life or death. So again, another thing interesting to note there, and I think it's definitely worth considering when obviously keeping an eye on the industry. And obviously, yes, I have had a very narrowed view set so far in this video, and I think this is because there's not much news going on at the moment, or not much that I would like to comment on. And as I said before, I like to comment on retail because it's very similar to the industry that I currently work in. I work in hospitality. Well, I suppose I work in a hospitality company now, but I'm now in finance. But in hospitality, I think there's a great overlap between that and retail. And personally, I shifted into retail because it's in my circle of confidence. Same with hospitality, but I really don't like the business model of hospitality compared to that of retail. And therefore, obviously, I shifted, pivoted, and I go to more consumer discretionary, consumer staples that are inside the whole retail sub-segment. JDSports Fashion has also had a trading update, and they've changed their timetable for announcing their financial results. They've prolonged it by, I believe, another month or so. They haven't actually given an exact figure, but they said it's to ensure that their auditor, KPMG, has sufficient time to complete its global audit procedures and allow the group to report on the outcome of the divestment of Foot Asylum Limited with greater certainty, and it will allow them to complete a review of their governance procedures and policies in light of the ongoing process to divide the current role of executive chairman and chief executive officer, in which the group expects to update on part of its financial results. They mentioned in their actual trading update itself that the group had announced total revenues for the 22-week period to the 1st of January. Group's like-for-like were more than 10% ahead of the same period in 2020. Now, I don't know if this is doing a 2-year like-for-like, which I would understand in perhaps businesses that have had significant closures during that time. In fact, actually at this point, you'd be looking at 3-year like-for-likes just before the pandemic, if you had been struggling, for instance, or if this is just comparing to exactly 1 year ago. It hasn't really specified here. I'm going to guess that they're in their financial year of 2021, and therefore, obviously, it is actually mentioning the previous financial year, which would make sense. But again, if this is talking about a point where the country was in lockdown, for instance, the stores were shut, then only being 10% ahead perhaps is a gloomier sign. But again, I don't think this is the case. And they said it's an equally positive performance across Black Friday and Christmas, and that it continued into January, and as a result, their full year sales or results are expected to be slightly ahead of previous expectations. Headline profit before tax and exceptional items is now expected to be at least £900 million, which again, I think is very much the figure that they gave last time I gave an update on the channel about this, although it might have tweaked slightly. There is a little bit more news with JD Sports though, and this is that JD Sports and Foot Asylum were fined almost £5 million for breaching a CMA order. CMA being the Competitions and Market Authority, or it says it down there, so obviously I didn't know that, I just read it off the screen. But it's pretty smooth, right? But anyway, apparently they were sharing commercially sensitive information during an investigation by the UK's watchdog, which has accused them of deleting phone records and found their chairman to have had multiple clandestine meetings, including one caught on video in a car park in Greater Manchester. Supposedly, well no, this is actually what happened. JD Sports bought the trainer retailer for £90 million in 2019, which was led to an investigation, during which time the companies were ordered to operate as separate businesses. In November, CMA ordered the deal to be unwound over competition concerns, and therefore obviously they've had to make a split here. However, they published the findings of a new investigation finding the companies a combined £4.7 million for holding 2 meetings in which they exchanged commercially sensitive information. I mean, this makes sense. They were already pretty good friends, and so the nature of this acquisition could be a concern to investors. After all, it might have been more favourable for the pockets of the executives than it is for the everyday investors of the firms, and therefore the watchdog, being CMA, Competition and Markets Authority, had obviously vetoed this. Is veto the right word? Had obviously tried to reject this because it may lead to some concerns, and that is to do with governance, because at the end of the day, if they're saying, actually, we're going to be talking about these things, we're already good friends, what's to say that JD Sports didn't try to purchase Foot Asylum for already a premium price? So it is a little bit of a concern. And I think in a way, I can kind of empathize with the executives here. I think from what I remember hearing about them, they're actually pretty good friends. And so obviously having the ability to discuss business matters at depth with someone that perhaps you trust that is in a similar industry, I think that kind of knowledge would be invaluable. However, they unfortunately would have to declare all of this information and make it, I believe, public property, which again makes sense from a corporate governance perspective, but perhaps not as favorable for someone looking to really grow their business and utilize that knowledge and perhaps their network to their advantage. Something that I think I would be more in favor of as running my own business or having a private company where you can discuss these matters at greater depth. You can really brainstorm this without worrying about the legalities. And I think in a way that's the downside of a lot of public companies, actually of pretty much all public companies. And the point is that the investors, the shareholders, they're always going to be asking questions. When you're a private company and perhaps you owned yourself, for instance, you haven't got to worry about all of these public opinions and all of these questions coming towards you. And in fact, I think a lot of resources are allocated to deal with these queries and questions, that it therefore means that, or it makes it difficult for perhaps these public companies to really prioritize growth in the future. But again, when you're investing in the stock market in public listed companies anyway, this is or public limited companies, I think that's what it is. This is very difficult in order to avoid, and it's something you have to accept as an investor of markets. The CMA said that JDSports and FTSE used its information gathering powers to try and develop a clearer picture, including submitting legally binding requests to the companies for information, but obviously they did not respond in full. Naturally, you would likely want to deflect that. And I think JDSports was fined £4.3 million for failure to comply with its order, and FTSE was fined £380,000. Now, if I quickly check, and I think I can go back here, no I can't, that's really annoying. So if I go onto JDSports RNS and we'll go to their analysis, I don't want to go on any other page, it just keeps it easier. Click here. And then I think they had actually a response to their CMA announcement, which we can see here that they did announce a £4.3 million fine, and this was failure to comply with certain respects to an interim order. Let's say JD has been subject to hold separate measures in relation to FTSE since May 2019, and balancing of obligations of separation and business stability over such a long period, which has also coincided with, right, okay, hang on. And not without challenge. At no point has there been any intention to break the rules. Obviously, you're not going to be saying we purposely did that. They believe that a number of the further conclusions with the CMA are drawn are either incorrect or have been presented in a misleading manner through the use of inflammatory language. JD would like to point out that they are suggesting that phone records have been deleted, and whilst JD accepts that some phone records are not available, it absolutely refutes any allegation that this was due to records being deliberately deleted. In regard, it can also confirm that it voluntarily submitted all of its relevant devices to a third party for expert forensic analysis. So actually, they are very much contesting this. I don't know obviously what they can do. They're going to review the detail of CMA's decision, or the group has already taken swift action to implement additional measures to strengthen its processes, but I don't think they really can do much as a whole. They did say that they always act honestly and in good faith in efforts to comply with the order and responding to inquiries from the CMA, which, yeah, whatever. JD has had a market standard guidance, yeah, whatever. No prohibition on the CEO's meeting, and indeed JD was actively required to retain the employment of FTSE key employees during the period of the order. There was no legal requirement in the order for JD to notify the CMA that a meeting had taken place or take notes of these meetings. So in a way, they are very much contesting this, and it will be interesting to follow the story as it goes on, although I think it's mainly in the past now because the penalty has already been set. There's not really much that they can do in regards to this position. I hope you enjoyed this episode. As I say, I'm trying to cover more market commentary. That's what I'm really trying to go for here. Strategy obviously is a big point of the channel, but since I've been buying less shares, I think I bought about 138 shares in Boohoo, it does mean that obviously things are, let's say, less interesting at the moment. So I'm really looking for more things. I'm continuing to study CIMA, which is a Certified Institute of Management Accountants. I'm getting ready to do my first exam, and hopefully with this knowledge that I'm learning through this accountancy exams, that I'm therefore able to offer you more value in terms of content on the channel. If you've not already seen my reaction to the hate comments video, definitely go check that out. If not, thank you for watching. Have a fantastic day.